Hey everyone, welcome back to Corporate Decoder, the place where we dig into the documents that tell the real story behind businesses. Today we're looking at Korth Direct Mortgage's latest quarterly report. Get ready for some numbers that might make your head spin faster than a mortgage approval process. Before we start, if you appreciate getting straight insights from corporate documents, make sure you're subscribed. We also have a Discord community linked in the description below for more discussion. In short, Korth Direct Mortgage had a mixed quarter. Revenue's up, but so are costs, and there's a lot of stuff going on with properties and debt. Let's get into the details. This is a Form 10Q, which is basically a checkup on the company's health filed with the Securities and Exchange Commission, or SEC. Think of it as a report card for investors, giving a snapshot of how they did between January and March of 2025. Korth Direct Mortgage is based out of Florida. They're in the business of originating mortgages and then packaging those mortgages into securities. So they make money by creating and managing home loans. As of the end of March 2025, Korth Direct Mortgage had 5 million shares of common stock outstanding. This is just letting everyone know how many pieces the company is divided into. Now for the juicy stuff, the financials. These are unaudited, meaning that an external auditor hasn't double-checked the work. First off, cash and equivalents nearly tripled to $6,879,240 TF compared to the end of last year. That is a good sign. Companies like to have cash on hand to handle their operation. Their mortgages owned decreased a bit to $417,417.48. Now this is a complex number, but essentially reflects the total value of all mortgages they own. It's a huge piece of their assets, but the fact that it decreased could mean a few things. It could mean they originated fewer new mortgages or that they sold some off. On the liability side, they have mortgage secured notes payable of over $453 million. This is their biggest liability by far. These are basically loans they took out secured by the mortgages they own. It makes sense that the numbers roughly correspond. Now, let's quickly scroll over to their deferred revenue, which is a bit over $1.8 million. This money represents services that they haven't completed yet. For example, future mortgage servicing. Lastly, their accumulated deficit is around $3 million. This means that throughout the course of their operations, they have had $3 million more in loss than in profit. Alright, time to see if the company is making money. Total revenues were up big, coming in at $4,698,227 compared to $2,062,171 from last year. So the company is doing something right. However, total expenses also went up. So gross profit, which is a calculation between revenue and expenses, came to $3,107.1922. The result is their income from operations is almost $1 million, which is good, as they were operating at a loss a year ago. Interest expense is around $480K. Interest is basically the expense of having debt, so it makes sense that a business with that many liabilities is paying that in interest. The key takeaway here is that interest expense went down from last year, meaning the company is managing their debt a bit better, even if it hasn't shrank. The company had net income of $846,098 for this last quarter, which is really, really good. Compared to a net loss last year, that is a massive turnaround. However, a good chunk of that went to Series A and Series B preferred stock dividends declared at over $500,000. These are essentially guaranteed dividend payouts for some early investors. Switching gears over to stockholders' equity, we can see some information about share-based compensation of about $13,000. This is equity given to employees as a part of their compensation package. They also list another $500,000 payout as Series A and Series B preferred stock dividends declared. Dividends are generally not so good if you want the company to grow faster. Additionally, there were contributions to fund of about $630K. Moving to the statement of cash flows, cash from operations and investing activities were a wash, but financing actually helped increase cash. Start looking deeper into cash flow. Let's look at some numbers for this last quarter. Mortgage loans matured or paid off came to about $590K. This might indicate that loans are maturing faster than new loans are being added. They also invested about $11K into more properties and equipment. The financing increase came from contribution to the fund of $623K. Alright, onto the notes, where a lot of the real detail gets hidden. Let's start with their debt policies. Letter issuance costs are amortized. Okay, boring legal details. As part of the acquisition of JW Korth in 2020, they had something related to preferred capital interest, which was finally paid off last year. They issued mortgage secured notes since they started for about 600 million and have redeemed 185 million of those. Here's the schedule of future principal payments of the 450 million in debt. Treasury looks very, very intimidating and might be very hard to understand. However, don't be afraid, they lay out all the payments and amounts due very clearly. You should always check these if you are considering investing in a company like this. These bonds can be very high interest, which is good for you as a lender, but can be scary for a company to pay out. These restricted cash accounts are basically accounts held in trust for borrowers and investors. Korth is also in the game of acquiring rental property. So sometimes when a borrower can't pay, instead of just taking the property through foreclosure, Korth takes a controlling stake in the property's LLC. That's what happened in Stafford, Virginia. They also took over some locations in Massachusetts and Missouri. With their properties, they recognize revenue based on leases. For the most recent quarter, it came out to around $1.5 million. This is not only a great boost to their income, but shows a new direction for revenue streams and diversification for Korth. Korth has a lease for their Florida office running for several years with the option to renew, so they are committed to staying there for a while. They have a paragraph that says that the assets they acquired through foreclosure amount to about 37 million. The company has a stock option plan. The plan is administered by the board of directors. That is good because there needs to be a high-level party to make decisions about things like this. They gave options to buy 15,000 shares of their common stock at an exercise price of $3.00. They have two types of preferred stock outstanding, Series A and Series B. These shares get paid first in the event of bankruptcy and have additional conditions after. On June 29, 2021, the company issued 19,000 shares off its Series B 6.5 start. Is redeemable. More financial information, but very legal. This long fair value section is all about how they value their assets. It defines fair value, talks about different levels of inputs, and explains the valuation process. They also mentioned they recognized a gain of $207,981 because the fair value of what they got was more than the debt the borrowers owed. Lastly, there is a lot of discussion about segment reporting and assets, but the key takeaway is that lending and servicing and asset management are the two segments. Alright, that was Korth Direct Mortgage's latest financial filing. There's a lot going on, so let's sum it all up and give you my thoughts. Looking at Korth Direct Mortgage, it seems like a company at a turning point. The increased revenues and shift toward net income are encouraging, suggesting they are managing their lending services effectively and starting to benefit from their asset acquisitions. I like their diversified approach, but I feel like their focus on high interest notes might be dangerous. They had a lot of debt, which is both good and bad as a source of their strength. They can grow faster, but it's a very risky position. Their financial health hinges significantly on managing their REO portfolio successfully, since it is becoming a big part of their assets. Lastly, the success of this company seems to depend on good management and leadership, who can predict where the market is headed. Overall, Korth Direct Mortgage presents a high-risk, high-reward scenario. Conservative investors might want to wait and see how their real estate strategy plays out. Those with greater risk tolerance may see opportunity, but should tread carefully and be ready to adjust as things develop. So what's your take on Korth Direct Mortgage after seeing their financials for yourself? Let me know your thoughts in the comments. If this analysis was valuable, hit that like button and subscribe for more financial deep dives. If you want to talk more about this, make sure to join the description. Thanks for watching. See you next time.